Okay, so welcome everyone to this session of finance. I'm your host today because Emiliano Ippolito is going to be interviewing our guests. And as most of you know, Emiliano is at the Department of the Philosophy at Sapienza, University of Rome. He's also the founder and host of the Finance Network. Today, he's going to be interviewing Conrad Heilmann and Marta Szymanowska, both of Erasmus University of Rotterdam. Conrad is Associate Professor of Philosophy at the Erasmus School of Philosophy and co-director of the Erasmus Institute of Philosophy for Philosophy and Economics. And Marta is Associate Professor of Finance at the Rotterdam School of Management at Erasmus University, Rotterdam. So Emiliano is going to interview Conrad and Marta on their jointly authored chapter in the Philosophy of Money and Finance. And the chapter is called Financial Economics, What Kind of Science Is It? I might also mention there's a third author, Melissa Viraga Fernandez, who's not here today. So Conrad and Marta will represent their chapter. Okay, and I'll turn it over to you, Emiliano.
Okay, thank you, Lisa, for your introduction. First of all, of course, let me thank Marta and Conrad for accepting our invitation, and we are truly grateful for your time. My questions take inspiration from your paper, of course, but aim to broaden a bit the scope of the discussion. And specifically, I will ask you 5 questions. And so let's get started. Here is the first question, which is split into 2 parts. So this way, each of you can take one part, I guess. And so the first question is this. What makes financial economics unique compared to other branches of economics? And second, why do you think it has been somewhat overlooked by philosophers and science until recently?
Thanks very much. Thanks, Lisa, for the introduction, and Emiliano for questions. We're very happy to be here. So indeed, this is I wanted to start with a shout out to Melissa Vergara Fernandez, who was a postdoctoral student that cooperated with us on this chapter. She's now an assistant professor at Groningen, still working on the cross between philosophy and finance. So she's continuing this work along the way, and it was great that she joined us for this chapter. Okay, so what makes financial economics unique? So I'm financial economist, so there's a disclaimer. I love the question. Well, so if you think economics studies how individual firms, governments allocate scarce resources in order to produce goods and services that we then distribute in the society, finance deals with also the decision of individuals, firms, and governments, but it's only about the financial assets. So how do we allocate, raise, and move over time money, financial resources? And because of that, so the bigger focus of finance is on the risk and uncertainty that is embedded in moving these financial assets across time, as opposed to questions that economic studies about goods, labor, or capital markets. And I think another key distinctive feature of financial economics is that it's perhaps one of the most applied branches of economics. And it also uses quite sophisticated mathematical, statistical, econometric tools. So this is a little bit different than many of the branches of economics. We have both theoretical models, but we also have quite advanced empirical models. So that's how I would see why this is perhaps it's a carved out market, market for only financial assets as opposed to real goods. Yeah, and why did philosophers have overlooked this market? I'm going to turn it over to the philosopher in the team to answer that. So, Conrad.
That's right. Yeah, thanks very much, Marta, and thanks, Lisa and Emiliano, for having us. So, why did philosophers of science or philosophers of economics not really talk about finance so much in the past period? I think it has partly to do with this fact that Marta mentioned about finance being much more applied than other areas of economics. And I think philosophers of economics have traditionally engaged a lot with theoretical economics. There's a tremendous amount of work on the philosophical foundations of rational choice theory, decision theory, game theory, social choice theory as well. I also think that theoretical models, general equilibrium models, feature quite heavily in the philosophy of science, on the methodology of economics, and perhaps this easier relationship between philosophy and theoretical economics has contributed to it. But otherwise, it's also, I suppose, something that has been done here and there, but not really in the mainstream for that very reason.
So thank you very much, Marta and Conrad, for your joint answer and for the joint effort. And okay, we now move up to my second question. Your work highlights the performative nature of financial models like the capital asset pricing model, CAPM. Can you explain how these models don't just describe markets, but actively shape them?
Yeah, thanks. Well, let me start by saying, so by performative model, we mean that the model impacts the words in such a way that then the words starts to look more like the implication of the model, more alike towards those implications. And we've studied that with the CAPM, so capital asset pricing model, that came about in the 60s, in 1965. And at that time, the typical investment decisions were basically focus on hand-picking selection of stocks that the managers would think would perform well. The portfolios were tailored towards investors. So if you were an investor that indicated that you don't want to take too much risk, your portfolio would be tailored towards safer assets. If you indicated you want to take a lot of risk, your portfolio would be tailored to more risky assets. And the CAPM basically challenged that. So the result of the CAPM model went against, you could say, the status quo of the investment practice. So what does CAPM says? The main implication of the CAPM is that investors should rather hold a well-diversified large portfolio of assets and refrain from trading a lot of information. And this is because markets are efficient, so individual investors are not able to really profit from that trade. So the CAPM has challenged the status quo, but also at the same time, it offered an alternative. So it immediately says, this is what should be done. And that alternative was hold well-diversified portfolios. What it means in practice, it means some kind of a passive index fund. And this idea was exactly picked up by Wells Fargo. So like 5 years after the CAPM came about as a model, Wells Fargo have interpreted it in such a way that they have created this first passive index fund. And from that point on, we have seen a growth in passive investments, more recently with the onset of those exchange trading funds that are much cheaper way of achieving this passive index holding. This has changed the investment universe. It made investment much more cheaper and also accessible to individuals. So this is the way we see that CAPM has not only described the word, but it actually has helped to shape the word into what it implies. And this has many implications also for philosophers, because it does immediately point out that, maybe it's not only epistemic import or value of the model that we should look at. And CAPM, we think, is a great example of that.
And thank you very much, Marta, for this detailed answer. And okay, we can now move to the third question. So the capital asset pricing model has faced significant criticism, and especially regarding the assumption and the empirical failures. Why do you think it remains so influential in both academia and in the financial industry? And a second sub-question is, what does its persistence reveal about the role and function of financial models?
Yeah, thanks very much. So I think it's important to first clarify, because we've heard that a lot. We financial economists, that our models are, have abstract assumptions and are too theoretical and not always supported in the data. So many of the CAPM assumptions exactly are unrealistic, but there are also a lot of extensions of the CAPM that have relaxed many of those assumptions. And the general logic, so the key aspect in which CAPM implies how risk and return is traded, carries on to those extensions. So the general implication, the core of the model, carries on. Also, in terms of the tests, indeed, the CAPM has failed in many important tests, but it also does work well on some markets, most notably emerging markets, but also in some periods. So like if you estimate the model in a conditional way, it actually performs quite well. So it's not the model is completely rejected. But why is it used? So in academia, I would say it's mostly used for this simplicity. So the model is very simple, but it very easily and intuitively explains the key concept. So the trade-off between the risk and return, and how that trade-off influences the behavior of investors and eventually determines the prices of assets in equilibrium. So this is the beauty of the model. Why is it used in practice? So there are some academic papers that have been surveying practitioners, and we know that, for example, 70% of CFOs, so chief financial officers, are actually using mainly CAPM in their estimates of the cost of equity. So when they are valuing investment projects, it's also used as underpinning the performance evaluation of mutual funds. And typically the arguments there are that this is a very simple model to convey the intuition to the stakeholders. So there are more complicated models that include factors that are less intuitive, and it would be harder for the manager to explain to the stakeholders what is really the underlying economic phenomenon captured with that model. So again, the simplicity, but more in terms of being able to motivate, justify the use of a model for a certain application. Yeah, so again, this shows that the models are not necessarily only relevant for this epistemic value. It also, because as I said, CAPM extensions show that if we relax some of those assumptions, the model, the intuition still holds, which means that perhaps the value of the CAPM is not absolute on its own, but it's in relation to all those other models. So we should evaluate the value of the CAPM as a CAPM family, and that's what we argue for. And it also shows that there is an interaction between practice or data or the models, because the performative aspects of the CAPM created this passive industry. This passive index industry is using only the stock market indexes representing this market portfolio, and that trickles back to the theory of the CAPM, which started originally by talking about the market portfolio, including all risky assets, so not only stock exchange. So there is some kind of a feedback loop back and forth. So that's that's how we see the relevance of the CAPM.
Thank you, Marta, very much, and that's fascinating. And we can now move to our last two questions. I guess that Conrad is the one responding to these two questions. And the first one is this. Ethics and sustainability are increasingly important in finance. And how do you see financial economics evolving to incorporate these values? And do you believe the discipline needs a fundamental shift?
Right, thanks. Yes, so I think, first of all, I would say that the world of finance itself is undergoing fundamental shifts in value. There's a lot of dynamics regarding which values drive investing these days, right? So there's the conservative value-based investing, by which we mean maximizing expected returns of investments or financial profits. But then there are also various types of values-based investing where, for instance, investors engage in impact investing or socially responsible investing, but also ESG investing. And there's sort of various types of those kinds of investments. And all these types of investments, whether it's traditionally value-based investment for financial profit or different types of values-based investment, they are currently adopted by different players, and that also changes, right? So you have some institutional investors, for instance, the large Dutch-based pension fund ABP, they're divesting from certain industries such as fossil fuel industries. And on the other hand, you have certain big players like BlackRock, they're reneging on some promises to do ESG investing. So there's a lot of dynamics in how values actually play a role in the world of finance. And so now what does this mean for financial research? So one of the things that finance research needs is it needs flexibility to pick up these shifts and analyzing these shifts. And it's interesting to analyze how finance research is currently able to do that and where it might perhaps need to improve. So let's zoom in on sustainable finance. There we have also an interesting development in the research. On the one hand, we have sustainable finance research that very much takes the traditional methods and models, for instance, issues in climate finance or sustainability as a sort of an external shock, and then is able to characterize quite a few things about the environment, about climate, and about sustainability. And on the other hand, we have an emerging literature that really drops some of the traditional assumptions of standard finance research and goes for completely different methodologies. And you have also researchers in those areas that really advocate for a fundamental shift in the discipline. Now, what I find interesting is that when we now ask this question, does the discipline need a fundamental shift? Then I would say, well, it certainly needs flexibility. Some people in the discipline argue it needs a fundamental shift. And I would say, on the one hand, no, it doesn't, because there's a lot of things you can do with traditional finance methods. But on the other hand, yes, you do, because you need to pick up these kinds of shifts in values-based investing that we see. And so both of these things, I believe, can be true at the same time, that you can do valuable work with the traditional or the conservative finance methods, but also interesting work with the newer methods. And I think that goes back to the first question we discussed about how is finance different from economics. So I think in economics, you have models that cover more ground. And so therefore, it is harder to be flexible in your modeling style. And I think in finance, because it models a relatively small part of the economy, there is perhaps more flexibility in picking up these kinds of dynamics of values. Nevertheless, it sort of remains an interesting subject for both methodologists of finance and finance researchers themselves, how this will continue.
Thank you very much, Conrad, for this insightful answer. And so, yes, we can now move to the last question. It's again for you. What challenges do philosophers face when engaging with financial economics, and how can interdisciplinary dialogue between finance and philosophy contribute to a better understanding of financial markets?
Right. Yeah, I think it's the eternal question that philosophers have been facing. What's the cash value of reflection, right? What's the cash value of methodological reflection? What's the cash value of thinking deeply about what's underlying certain developments in all sorts of areas? I suppose that the work we've been engaged with has kind of two dimensions. So one is the fostering methodological reflection of financial scholars, and I think that is probably a very long process. And I suppose what philosophers can do there is that they can first produce things that make sense philosophically, so that at least they know it has some sort of cash value. And I suppose then there's a second phase of really engaging financial researchers with these kinds of methodological reflections and see whether they might be taking some of these inputs and further develop the discipline. For instance, is it opportune to move beyond quantified methods or in some areas of finance? Or how can we actually decide whether a certain twist on a certain model, for instance, with the CAPM, whether that really generates a lot of additional knowledge, or whether perhaps there's other scientific explanations and predictions finance should be going for. So I think that's one area. And the second area is this idea of an interdisciplinary dialogue being needed to have an additional level on which we can figure out the dynamics of value and values in financial investing, and also in research on these dynamics. And I think there we might be making quicker progress in finance researchers, appreciating the help of the discipline of philosophy to help with the sort of reflection on the ethical values that underlie investor behavior, but also that go into these kinds of normative questions about sustainability and ESG investing that we've talked about a little bit.
Thank you very much, Conrad, for this very interesting and challenging answer. And we can now move to the Q&A. And so I leave the room to Lisa.
Okay, any questions here? Okay. Maybe I'll start. I wanted to ask the two of you if you think there are particular ways in which the philosophy of financial economics can shed light on questions within the philosophy of science. Do you see a particular contribution that the subdiscipline could make to some, prevailing questions in the philosophy of science?
Yeah, so I suppose I would see immediately two things that at least follow from the kind of work we've done, where we feel like it has certainly challenged us, our understanding of questions in the philosophy of science. One is about the role of models and what kind of role models play, and this idea of not only analyzing one single model, but that models come in families and that models come in variations, and that in order to really appreciate what models can and cannot do, you should analyze a family of models or a collective of models, and not only one model. And I believe that financial economics is a really interesting case study, because we have that phenomenon in other sciences, but they're sort of, again, different. For instance, in climate models, you have this sort of ensemble modeling, but then it's more about combining different models and doing something there. And I think in financial economics, we have really interesting cases of multiple models, of multiple variants of models being analyzed. So I think it certainly also contributes to the diversity of scientific cases that we subject our philosophical theories of modeling to. And the other thing I would say is that, Emiliano already asked about the performativity of the CAPM, or performativity of financial models. And I think for us that also means that perhaps as philosophers of models, we have been focusing a little bit too much on the epistemic benefits of models and not talked enough about other effects models have, or other functions models may have, communicating baseline results, practical applications, and also really shaping the world. I mean, the CAPM has changed the world of investing quite a bit. And that's something that philosophers of modeling just haven't really picked up. It's sort of been picked up by science study scholars. So in STS, you have a long tradition of studying things like performativity, but philosophers of modeling haven't done nearly enough work, I think, to appreciate the non-epistemic aspects of models, and that's what financial economics can help us with to do better on.
Yeah, good. Yeah, sounds like maybe your next paper on this. That could be a discussion in itself. Okay. Questions from the audience here? Anyone?
Otherwise, I have just a curiosity in case there are no questions coming from the audience. Okay, so yes, my curiosity is this one. If you are considering studying the performative effect of other models besides CAPM or maybe the Black-Scholes-Merton models, which is the standard in this case. I mean, with at least in the work of Donald McKenzie.
Yeah, I mean, maybe Marta as another example, but I think first on my list would be behavioral finance. I think there's now a lot of work done in the finance industry to tailor investment products to sort of different risk profiles of investors. So I think I think it started with sort of family offices and high net worth individuals, where then really people get sort of bespoke investment solutions for their risk profile, and you have actually people who develop these kinds of risk profile on behavioral finance research. So this happens, for instance, at Barclays. They have sort of in their bespoke investment banking, they have people who really know behavioral finance models and really use behavioral finance research to first make a variety of experiments with their clients to find out about their risk profile, testing all the supposed biases about risk that behavioral finance has unearthed, or at least so they claim, and then use those kinds of insights to build actually a customized portfolio. So there's certainly, and I think that sort of work has rolled out to larger groups of investors, and I think that's also a clear case of performativity, where behavioral finance research changes the availability of investment products. So that's certainly a sort of interesting case to look into.
Okay, any other questions here? Okay, Christian, yes, you need to unmute.
Okay, sorry to be late. Sorry to be late. Thank you very much. I was wondering about a possibility of considering the models and CAPM in a theoretical view. I mean, is it possible to consider that, for example, the fund manager as just playing a kind of performance in a theatrical sense of the word, and the mathematical structure of a CAPM would act as a script, a scenario for playing some role in a kind of role play instead of performativity in the classical sense of this word. And well, I was wondering if it would be possible to think about a mathematical model as a kind of a script for a role play. Maybe it's only a different way of thinking about the performativity. I don't know. Just to have your thought about this.
Yeah, I think it's interesting. So I struggle to see how that would be extensionally different to talk about. I mean, wouldn't it be the same? Wouldn't it ultimately be giving a sort of the same or very similar kinds of explanations? So what's the difference between your sort of role-playing script imagery and the sort of the performativity that we might find there. So so what I'm saying is that isn't that just compatible? I mean, so in that sense, I would say, you're welcome to your imagery, but what difference does it make to the analysis? Maybe you have something really specific in mind that we can say with your analogy that we can't say with performativity, but I'm not seeing that yet.
Maybe performativity could be more adapted to a way of thinking devices embedded in the way of managing fund. I think about the way of transforming the mathematical models in terms of tools and practical tools for calculator risk and return. But I would say it would be maybe a passive way of transforming finance, and maybe a role play view would be a more active way of playing a role for fund managers. And for managers, it would be a way of saying, well, I'm good because I am playing the role I am supposed to play with the assumptions of the CAPM. Maybe it's not either or, maybe it's the two simultaneously, like two sides of the same phenomenon, more active and more passive. One inside the tools and the devices of practical instruments, and the other in terms of role playing for managers. I don't know. It's just an idea.
Right. I think we shouldn't read too much into the label of passive investing. I mean, it's passive for the investors, but it's not passive for the people who are designing the products. And I think so in that sense, I think you're right. I think what goes on is that people in the financial industry take, for instance, the CAPM as sort of the baseline model. I mean, that's what Marta said earlier, right? That a lot of people in the financial industry use the CAPM as a baseline model, and then I guess, if you like that sort of imagery, I think you're welcome to it, to say that what happens in the financial industry, that people engage in a certain performance where they all start with a CAPM. Nobody can afford to not start with a CAPM on some way, but then also you can't afford to not differentiate yourself a little bit from it, because you still want to get some sort of differentiation for your products and services. So in that sense, yes, the CAPM is the script, and then the people who want to sell investment products have to put on a performance, and whether that's a rhetorical performance in selling their portfolio or the financial performance of their portfolio is sort of a different question. So I think I would agree with you. I'm just not seeing what the imagery adds analytically at this point.
Just maybe to be more precise, if a fund manager wants to prove that he has very professional skills, and he wants to say that he is a good fund manager, he just has to prove that he has followed the rules of CAPM, and follows the rules is to play the script. And it is different, for example, from the consideration of the tools inside for example, the sheets for calculated the risk and returns. Maybe in one side, it's a way of thinking, the practical environment of the fund management, and the other side, it would be more oriented to human actions and playing the role. And if you think about the word performance can be understood either in financial terms, for example, the Sharpe ratio on risk and return, but to perform is also in theater to play a role. It's the same thing. So a good performance can be simultaneously a good risk-return ratio or a good role playing in a theatrical scene. It could be the two, with playing with the word performance.
Yeah, I mean, I guess I would still. I mean, I think you're welcome to that imagery. I would say.
The paper I just sent you before the interview precisely developed this idea of considering the CAPM like a script for role-playing of fund managers in a theatrical scene, just to give an example, with the desires of fund manager and the desire of algorithms with the tools. It's not contradictory, in my opinion. It's just a way of thinking the same thing with two different angles. Maybe more human and maybe more device-oriented. I would say human-oriented or device-oriented. But maybe the same thing that you just have examined yourself.
Okay, good. So I think this might be a good place to conclude. And I would like to thank Marta and Conrad, also Emiliano, for his questions, and to thank all of you for coming today.
Thank you very much.
Great. Thank you.
Thank you.